We have a lot of content. We have the company results of Singtel, StarHub, ComfortDelgro, SATS, HMI, and the site visit for Centurion, sector updates of the Singapore REITs monthly, Singapore Co monthly, and the weekly updates of US, China, and Singapore. So we'll start off with Singtel's results. So for Singtel's revenue, it was supported by strong postpaid momentum in Singapore and Australia, particularly growth in equipment sale, ICT, and digital services. This helped offset carriage erosion. EBITDA shrank 8% because of the margin erosions in carriage services and the lower ambient migration revenue and prior year one-off items. Singtel was particularly dragged down by the regional associates by Airtel and Telkomsel. Net profit shrank 14.2% because of the lower EBITDA and the associates' contribution. So for the positives, postpaid subscription increased 112,000, 4.6% year-on-year, and 129,000, 6% year-on-year respectively for the Singapore and Australian market. The increase is driven by the conversion of prepaid customers into SIM-only plans and existing customers taking up secondary postpaid plans. Management shared that the mobile postpaid market in Australia commands the highest value as consumers are shifting to premium networks such as Optus and Telstra. Equipment sales are up 31% year-on-year due to higher take-up of premium handsets. The other positive is the enterprise gaining traction. Group enterprise revenue increased 1% year-on-year compared to a decline in the previous 4 quarters. This is because of the improved managed services revenue and cybersecurity business. Enterprise group order book grew to 2.9 billion in 2019. So for the negatives, weak regional associate performance, Airtel reported their 4th consecutive quarter of losses at 129 million this quarter. Because India is facing prolonged pricing pressure from Reliance Jio, recovery of Telkomsel was modest and at the lower end of our expectations. We expect Telkomsel to tap on growth of data use in Indonesia as subscribers begin to convert their traditional voice services to data. Telkomsel grew on a sequential quarter basis. So we continue to be optimistic on Singtel because of their earning diversity and the stable dividend yield of 5.9%. Although data revenue growth is not expected to offset the decline in traditional voice revenue, we expect other business segments to contribute positively. Next, we'll move on to StarHub. For StarHub, revenue was dragged down 2.2%, lower contribution from mobile, pay TV, and sales of equipment. EBITDA shrank 2.1%, lower due to losses from Ensign and Decrypt, higher provision for customer loyalty programs, and one-time SFRS 15 adjustments. For positive, there's solid growth from enterprise. The segment enjoyed a revenue growth of 70.3 million, that's 16% year-on-year. The growth is attributed by higher contribution from managed services where there is high demand for cybersecurity, cloud, cryptographic, and digital solutions. For the negatives, revenue for mobile, pay TV, and sales of equipment declined. Mobile revenues decreased 14% year-over-year in 4Q18. We observed a 10% decline in mobile postpaid ARPU from a year ago as consumers continued the shift from traditional bundled plans to SIM-only plans. StarHub added 34,000 postpaid customers, a dismal amount compared to its competitors M1, 91,000, and Singtel, 112,000. Pay TV revenue saw its biggest year-on-year decline in 4Q18. Revenue shrunk 16.8 million, and that's 19% year-on-year. The decline is contributed by a decrease in subscriber base, 49,000, and lower ARPU year-on-year. Sales of equipment revenue declined 33.9 million. This is due to lower handset sales. So for outlook, StarHub is switching from a fixed to variable dividend policy and to at least pay 80% of net profit each year. Cuts dividend to 9 cents per share from current 16 cents. We expect cost of services to increase as the migration of HFC customers to fiber continues, And the pay TV segment could see a change in cost structure as there are content contracts up for renewal that will change from a fixed base to a variable base. So you can see in the figure here that StarHub has been all along paying dividend above 100%. And this is the change now. The dividend policy change, you will be paying at least 80%. Management has also communicated to us that they will be paying a quarterly dividend of 2.25 cents per share. This adds up to 9 cents a year. And next, I'll pass on to Paul to talk about HMI.
Thanks, Avin. Sorry to jump around the slides because we have another event to attend to. Minin is not here. She's at the DBS results briefing. Just to give you some updates on the HMI. As you know, HMI actually owns 2 hospitals in Malaysia, one in Malacca and one in Johor. So overall, the results have been good. I think the key part here is that the revenue actually organically rose by 11%. Part of it is due to better patient load, and part of it is due to bill size. I think this is this is a very positive number considering that, you know, in Singapore, private hospital admissions are actually down maybe around 2%. But for these 2 hospitals in Malaysia for health HMI actually up almost 7% here. And as a result, you can see that the occupancy is actually continuing to rise. The only thing negative was because the headline numbers are down, the earnings are down despite the strong revenue is because they've actually acquired a hospital in Singapore. And as a result, there are startup costs for this facility, and that's why it's dragging down the overall earnings for the time being. Another thing that they are pushing harder into Singapore by acquiring 6 primary care clinics. This will enable them to fit into StarMed, the acquisition that they've made. Okay, this is not your typical hospital, StarMed. Basically, what it does is actually it doesn't take in inpatient. It's mainly for turnaround patients that should be discharged within 24 hours. So it's not your typical hospital. Okay, I will move on to my slides. Sorry to jump around, just that I have to go off somewhere. I need just to give you our Singapore, sorry, just give me a second, sorry. Just to give you an update on our Singapore, for the week 8 Singapore Weekly. Anyway, the key thing is that the macro for Singapore is still weak. I think like retail sales is one of the worst numbers we had, and also even tourist arrivals are down. And of course, but the US macro is still positive. In terms of the corporate events, I know there have been multiple corporate events, but I guess the one that has one of the big headlines has been HyFlux. And we just 2 things to take note. Again, we don't have coverage on HyFlux, but I guess since this is such a well-publicized event, just to shed some color. Firstly, for existing shareholders who hold the shares, you actually will end up with only 2.74% of the new entity. And your equity, the implied equity is only 18 million. So as you know, before HyFlux was suspended, the market cap was 165 million. So shareholders of that were actually now, the implied equity is now down back to 18 million. So even the shareholders are probably taking like a 90% haircut. The implied equity value is because, as you know, SM Investors is injecting 400 million for 60% stake. So if you use that, the implied equity value for HyFlux is now about 667, and 2.74 now is only 18 million. I think the other part for your clients who have the perpetual or preference shares. So I guess the one that impacts your client, of course, the shareholding here, the 2.74, and this part here, which is the 10.26. So your 900 million now converts to 27 million cash and 10% of the new HyFlux, which your equity value is, again, this is just an estimate of 68 million. It might be higher or it might be lower, but the problem is that once it gets relisted, as you know, there's typically selling pressure. So the implied equity value may actually face some downside. Okay, but anyway, in terms of the tactical views, I think it's all still positive for now. As you can see that the policy risk from interest rates and also the trade war has been faded, and that's why we got this market rally. And for those who do not know, I think that in the last 24 hours, we've seen that Donald Trump has tweeted on the trade deal with China. Some of the words that he's quoted is that the talks are now productive and big progress has been made. So as you know, the timeline is 1st of March and it's only 2 weeks away. So positive news on this trade deal actually will dictate the sentiment for the whole week, which will be positive. In terms of the bank results, as you all know, there's a DBS results came out this morning. Our analyst Minin is at the briefing, but just 3 key things if you have to tell your client. Now, firstly, the dividend yield is attractive. You're looking at a $1.20 for dividend per share for the whole year, so it's almost a 5% yield for DBS. Secondly, the ROEs for DBS is almost at 5-year to 6-year highs. Hopefully, I don't jinx it. But anyway, the third point to note is that what is important, the difference this time around for the results is that a lot of it is actually interest income. And the good thing about for banks when they have earnings from interest income is that it is more resilient and because you have your existing loan book and it's not as volatile as from trading income or fee income. So these are some of the 3 key points that we wanted to mention on DBS. I think after the results, Mini will give more details. Anyway, we'll just go back to the original format for the next person to present. Yeah, thanks.
Hi everyone, this is Richard speaking. Yeah, so now we'll start with results for ComfortDelgro. They announced their results last week. We downgraded to accumulate because of recent price appreciation. The downgrade was from buy to accumulate. Target price, slightly higher target price of 272. And then for FY19, we forecast a dividend of 11.4 cents. That will give you a 4.8% yield based on last Friday's close. So for the for fourth quarter, they have proposed a final dividend of 6.15 cents for fourth quarter 2018. That's higher than last year, which was 6.05 cents. So for full year, they have 10.5 cents dividend. That's on a 75% payout ratio compared to last year, 10.4 cents. That was on a 77% payout ratio. So for revenue-wise, it was 6.4% higher, mainly from the public transport services business segment and the new acquisitions that they did. So for public transport services, that's the bus and rail. The new acquisitions accounted for slightly more than half of the revenue increase. And then if you go down the line to the operating profit-wise, there was a 7% increase year on year. And the new acquisitions contributed almost 21 million of that increase. And for net profit after tax, there was a 2.8% increase, and there was contribution is also coming from SBS Transit, where its contribution increased to 22% from 13.5% last year. For profit after tax and minority interest, there's a marginal increase of 0.6% year on year. That's also because of the non-controlling interest from SBS Transit and of course Vicom, but most of it is from SBS Transit. And then on a recurring basis wise, actually profit is higher 4.4% because there was a special dividend in FY17. So if you exclude that 10 million special dividend, you get a recurring 4.4% year-on-year increase. So for positives wise, public transport services has benefited from SBS Transit, where they had a 64% higher operating profit. Also, downtown line has narrowed. This is because of higher ridership there was a full year contribution from the full downtown line. The stage 3 opened in late 2017. So 2018, there was a full year contribution for downtown line. Full year contribution for the full downtown line. And then negatives wise, taxi profit was 4.2% lower year on year. This is, of course, the whole group level. For the Singapore side, the average fleet size in Singapore decreased by 17% year on year. So average is the average for every month in 2018 over the average for every month over 2017. And finally, goodwill on the balance sheet is increased. This is because of the various acquisitions that they have done in 2018. So this would have some difference between the NAV and the NTA. For outlook-wise, it's still positive. Public transport services to continue driving the earnings growth in FY19. This is mainly from the continued narrowing of downtown line losses, and then full year contribution from all the acquisitions they did in 2018. In terms of Gojek wise, near-term pressure to be expected, but it should not be as prolonged or as severe as during the Grab Uber era. The key change, what's different this time around, is because of the private hire driver license. Before, they did not need a license, and the deadline to get the license was in June 2018. But now there's a requirement for the license, so the available pool of drivers has shrunk considerably. So you will not get a lot of casual drivers coming in. Also, you know that all the incentives and promotions are not sustainable as well. So this type of pricing mechanism is not sustainable for the ride-hailing apps. Okay, so now I move on to SATS, which also announced their results last week. For SATS, we maintain accumulate, and target price was unchanged at 547. We forecast a dividend of 18 cents. That's a 3.5% yield based on last Friday close. So for third quarter wise, it was generally positive. Higher volumes around. So revenue was higher, driven by both higher revenue from the food solutions and the gateway services business segments. They both had higher volumes. So higher volumes of food produced and higher volume of passengers handled. So for EBIT wise, despite the higher revenue, EBIT is lower because of the OPEX grew. OPEX growth outpaced the revenue growth. Some of this OPEX was due to professional fees, so some of it is one-off. For associates and JV wise, there was a significant jump, 51%. But take note that is because of a one-off gain, 5.8 million one-off gain because they have divested one of their associates. So organically, food solutions was actually lower. This is coming from Brahim's. That's their food catering in Malaysia. And then there's gateway services was about 68% higher, but that's because of the one-off. Net, if you exclude the one-off, you can see the 20.7 million here. If you exclude the 5.8, you would still get year-on-year growth over last year's 13.7. And then PATMI was 3.5% higher. So even though EBIT is lower and associates is higher, you can see that associates still contribute quite a fair proportion to the bottom line. And then for PATMI wise, margin was slightly lower. But then if you exclude the one-off, underlying net profit is still positive, although it's a bit smaller year on year to 1.6%. So for positives wise, there was higher food solutions revenue. This was due to higher meal volumes across the group. I'm talking about the revenue segment now, and that's coming from Singapore, Japan, and China. And then for gateway services, revenue was also higher, driven by both the aviation and the non-aviation segment. So for aviation, that's coming from Singapore Terminal 4, which newly opened, and then non-aviation is the cruise center, the Marina Bay Cruise Center. So this cruise center is actually becoming quite significant, this business. Firstly, there has been larger throughput of cruise and passengers coming through that cruise center, and then there's also 2 cruise ships that have started to home port at the MBCCS. So what home porting means is that this is their base, and so that will bring about consistent revenue throughout the year, and not the seasonal type where the cruise ship just comes and stop by for a while. And then lastly, there was a higher associates and JV contribution. So for negatives wise, I already mentioned the OPEX growth had actually outpaced the revenue growth, and this had caused lower EBIT and of course compressed the EBIT margin. Otherwise, it's still positive. Passenger traffic is expected to drive volume growth, and this can help to offset pricing pressure from the airlines. Also, the group has been investing in new central kitchens in China to supply fast casual restaurant chains in key cities. So the expectation of volume growth is actually driven by aviation demand and also demand for quality food. So this is both aviation and non-aviation side. Okay, now we'll move on to Natalie, who will talk about the Centurion site visit.
So I'll talk about the Centurion site visit to Bukit Minyak Centralized Workers Transit, which is actually a purpose-built workers' accommodation. This is Centurion's newest workers' accommodation asset, and it will contribute 6,100 beds. So a little bit about Centurion. Centurion is in the business of building, developing, and managing purpose-built workers' accommodation and students' accommodation. Most of their assets are, most of the revenue is from purpose-built workers' accommodation, about 73.2%, with 25.5% from student accommodation. Most of these work accommodations are located in Singapore and Malaysia, and the student accommodations are in Singapore, Australia, UK, and US. So Bukit Minyak is the first worker accommodation in Penang, but it is Centurion's 7th worker accommodation in Malaysia. The other 6 accommodations are located in Johor. The significance of this addition to the Centurion portfolio, it will add approximately 10% more beds to the total portfolio of 62,000 beds. Recently, in January 2018, Centurion actually closed the worker accommodation, and due to the expiry of the land, this Tuas Westlake worker accommodation contributed 8,600 beds to the portfolio and was generating approximately $22 million in revenue. So the new Bukit Minyak will add approximately 3.2 million to the revenue, the top line. This is a really small increment in comparison to the loss due to the Westlake closure. So from the opening ceremony of Bukit Minyak, it was actually graced by Mr. Jadip Singh and Mr. Tuan Chao Kon. These are the members of parliament for the Penang State Exco Housing, Local Government, Town and Council Planning, and the Chief Minister of Penang, respectively. They expressed great support for the for having worker accommodations in Penang. So the Penang State government is actually trying to make amendments to the Employment Act to require employers to provide adequate housing for foreign workers in all sectors, as well as amendments to the Housing Development Law to outlaw the rental of low-cost and medium-cost units to foreign workers. These low-cost and medium-cost units are actually meant for local residents. The new Bukit Minyak facility is targeted at factories located in the Batu Kawan Industrial Park, such as Flextron, Inari, Western Digital, and Ibidon. So that's all for me. I'll pass the time on to Tara, who will go through REITs monthly.
Hi, so I'll talk about the SREITs monthly report that we released last week. The SREIT total return rose 7.5% year to date. So this is outperforming the STI's return. So just to note that year to date is just since Jan. So that's just about 1.5 months of performance. And right now the SREIT yield spread, it dipped slightly below the -1 SD line. If you had read our previous SREIT reports, you would have noticed that the graph is a little different. This is because the mean and standard deviation is now representative of the cumulative average and standard deviations. So the dividend yield is currently 4.82% and the 10-year SGS is 2.14%. So the forecast for the 10-year SGS at the end of this year and next year are at 2.71 and 2.7% respectively. And this rising interest rate will be a headwind for the SREITs going forward, though it can be mitigated by rental growth for certain subsectors, which I'll expand on later. And if you take a look on the right, the 3-month SOR, which is indicated by the red line, has increased quite a bit since the start of last year. So it ended January at 1.91%. That's almost double of what it started off at the start of last year. And I think we have mentioned this in our past few reports that upon our assessment that most of the REITs have at least 70% of their debt hedged on fixed interest rates. So this mitigates, this shields them from the higher near-term financing costs. And I'll just zoom in on the various subsectors. So for retail, the tenant sales growth is still pretty weak, and this continued to weigh down on the rental reversions for the listed retail REITs. So for CMT and FCT, both recorded very tepid tenant sales growth. CMT only a slight uptick, less than 2%, and FCT actually recorded a decline in their tenant sales growth. And in addition to this, the occupancy costs had not seen any notable improvement, and this is in addition to the fact that the figures had been rising over the past few years. And moving on to the retail sales index. So the RSI data came out last week, and this was actually a very bad showing. It declined 3.3% year on year in December, with declines in all sub-segments, save for just one. Only the F&B index was up about 4.5% year on year in December. And on the graph on the left, this is the rental index and occupancy. So you can see that what we were saying in the past few reports were that the landlords were trading off the occupancy to increase the rentals. But you can see that even now the occupancy has been dipping down even further, with little or no change in both the central and fringe retail index. And on the right, this is the demand supply for the retail space. You can see that 2019, there's a very big spike in supply. This is surpassing even both the historical annual supply and historical annual demand for the past 6 years. So we're neutral on retail. For office, we are more positive on this because of the upward trajectory that has been shown in both the central and fringe office index as well as the occupancy. And this current upward trajectory will continue to be supported by the strong demand that's still coming in from various sectors, co-working space being one of the stronger sources of demand, and also the tapering supply. So if you take a look on the left, the supply is actually a very good figure, well below the historical annual supply and above the historical annual demand. And moving on to industrial, we are neutral. So on the left, you will see the graph for the rental index and occupancy. The rents have remained flat year on year in the fourth quarter of the calendar year, while occupancy inched up slightly. This was driven more by the single user factory and warehouse segments. And there's also a tapering supply situation for 2020, but industrial activity has been tempering our expectations. And since the REITs have reported their 4Q results recently, the rental reversions that we've observed for the industrial REITs were generally negative. And that's because tenant optimism in the second half of the year was generally lower than the first half, as the tenants have started to taper their expansion plans. And these are the graphs for the warehouse and business park space demand supply. And for hospitality, we are overweight. So the average RevPAR rose about 3.5% year on year, reversing the negative year on year growth recorded in the past 5 years. So this is a very good showing for the full year. And on the graph on the left, you can see that the light blue line is actually the luxury segment and the dark blue line is the economy segment. So this was driven mostly by the luxury segment, followed closely by the economy segment. So interestingly, why the economy segment performed so well was because of, according to a REIT manager that we spoke to, there was a lot of stopovers in Singapore from the India cruise segment. So a lot of visitors from this, a lot of traffic from this class of visitors. And luxury segment, as you know, most of the retail REITs have the luxury and the the higher end segment within their portfolio. So this would be good for the office REITs. And this has shown in the hospitality REITs results. So RevPAR for the Singapore portfolio for the listed REITs were resilient, with with the boost stemming mostly from occupancy rates rather than average room rates. And if you take a look on the right, this is the upcoming supply. So the upcoming supply is a 3-year CAGR of 1.3%. And this is already a lower growth rate compared to the previous 3-year CAGR of about 4.3%. So lastly, our SREIT subsectors and recommendations. So top down, as we highlighted earlier, higher interest rates will be a negative for the sector, but this is not necessarily a doom and gloom situation, as provided the REITs can grow their rents faster than the rise of the interest rate expenses, or they can manage their capital structure well for any upcoming acquisitions. So we remain neutral with selective subsector preferences on office and hospitality, and our bottom-up view is unchanged for the rising interest rates. So do look for REITs with the low gearing, high interest coverage, long weighted average debt to maturity, and higher proportion of debt on fixed interest rates. So some of these REITs are CCT and Capital DC REIT, both of which we have accumulated calls on. And this is our SREITs universe. Now move on to Guangzhou.
Hi, good morning. It's Guangzhou here. So next I will talk about Singapore Coal monthly updates. So still we'll need to talk about China and Indonesia market. So in China, in January, there was an deadly accident happened in Shenmu County in Shanxi province. So the accident was that the roof collapsed at Lijiago coal mine in that area. So this accident actually triggered the shutdown of the 70% of the mines, which was the instruction from the local government. So the actual impact was that 70% of the coal mines with an annual capacity of 130 million tons were shut down temporarily for safety inspections, investigations, and also the rollout of the safety checks was extended to the neighbor provinces such as Shanxi and Inner Mongolia. And this rollout is expected to last until March this year. So generally, this impact is that it will support the coal prices as of now. Later, we'll discuss about the consequence of this accident. So in Indonesia, the central government lowered the 2019 domestic production target by 5 million tons to 480 million tons. So actually the lower production target was in line with the slowdown of the global economy as well as the coal demand. Meanwhile, in January, rains, there was heavy rain happened in South Kalimantan. So these rains delayed the loading schedule by 6 to 9 days. It is worth noting that both Geo and Golden Energy Resources had their mining operations in this area, which means that highly likely the operation of both counters will be impacted as well. So we see that the accident in China will temporarily support the coal prices because of the supply shortage. Because we know that in February there was Chinese New Year, so actually the mining activities were lower than the usual months. So actually this accident was further decrease the mining activities as well as operations in this area. So we do think that after the Chinese New Year, the Chinese government may relax the restriction on coal imports, mainly due to the decrease in the port coal inventory. Later we'll show you in the charts. So for the Indonesia side, we think that the local coal miners will continue to embrace the headwinds because in January, the HBA, the coal price reference from the government, was flat. That means the coal prices didn't improve much. So these 6 charts shows the current situations on both markets. So you can see that here the HBA price in January was flat and didn't improve. And also the port coal inventory in China continued to decrease in January. So we have a reasonable expectation that the government may relax the restriction, because after the peak season, the ports will need to resume the supplement of coal level. And also in 4Q, we can see that the thermal coal demand continue to increase because of the winter season. So next, I'll pass on to Edmund to talk about US.
All right, thank you, Guangzi. So right now I'll cover the US weekly. So for macro last week, the core inflation rate was higher than expected. It increased 2.2% year-on-year in January 2019. And this is in line with the Federal Reserve's target rate of 2%. Since the inflation rate is currently rather stable, it is difficult for the Fed Reserve to justify a further increase in the interest rates. As for retail sales fell 1.2% in December, which is the largest drop since September 2009. Sales fell the most at gas stations. It declined 5.1%, but this is to be expected because in December, the gasoline prices was falling. Meanwhile, internet sales also posted a 3.9% decline, and that will mark the sharpest drop since November 2008, which is the middle of the previous recession. But if you look at the industry accounts, online merchants led by Amazon and eBay actually beat sales gains. So is this a concern for the US economy? It is difficult to say because in December, the stock market tanked and there was a lot of talk about the recession, which may have hurt the sales. The University of Michigan consumer sentiments was also remain elevated at around 95.5 in February, exceeding the expectations of 93.7. The measure of current conditions rose 1.2 points, while the expectations gauge jumped 6.3 points, which indicate that the consumers are still rather bullish on the future economy. And given that it is likely that the gauge may stabilize as the government skirts another shutdown, and US trade negotiators work towards a new deal with China. And this morning, Trump tweeted that the ongoing trade deal with China is having a great progress. So that will provide some sort of uplift to the consumer sentiments. As for the corporate news, Cisco posted better than expected earnings of 0.73, and he guided that its revenue will grow 6% on a yearly basis in the third quarter, which amounts to 12.97 billion. So this shows that its transition from a networking company to one that focuses more on application and network security has paid off. As for NVIDIA, after guiding down his EPS, his earnings for twice, he actually beat the market expectations and reported EPS of 80 cents and revenue of 2.21 billion. So NVIDIA mainly blamed the decline due to a severe gaming downturn, which is based on several factors. One of them is the poor sales of its RTX graphics card, which were below its expectations. This is mainly because there wasn't a lot of games that uses its new ray tracing software. So as more games are released with this ray tracing architecture, it is likely that the sales will pick up. Also, the data center division of NVIDIA declined 12% year-on-year. This is mainly because hyperscales are currently undergoing a cloud digestion phase, which we will talk about later. And we expect that the cloud capital expenditure would likely pick up after the first half of 2019. For the week ahead, some of the key indicators to be released will be the durable goods orders, the initial jobless claims, and the existing home sales. So this is the list of the upcoming earnings release for this month. So some of the main ones would be Walmart, Berkshire Hathaway, and Square. Okay, so right now we are move on to cloud computing. So a bit of definition and background on cloud computing. So basically, cloud computing is the delivery of computing services over the internet to offer flexible resources and economies of scale. So instead of having servers in data centers, everything is over the cloud, which is on the internet. And hybrid cloud is basically a cloud computing environment that uses a mix of on-premise. On-premise is basically the traditional data centers. Then we have private cloud and third-party public cloud services. Multi-cloud is basically the usage of cloud computing services provided by two or more cloud service providers, which will include Amazon, Google, or Microsoft. So we track a list of capital expenditures for 14 companies that we believe have the highest capital cloud capex. So as seen from this graph, the capex growth has softened for the past 3 quarters. And this is mainly because there was a huge increase in cloud bookings, cloud capital expenditure bookings from Q4 2017 to Q1 2018. So naturally, they will need some time to digest the bookings first before they continue. So with that, we believe that the total annual capex growth is likely to moderate from 28% in 2018 to about 26% in 2019. Overall, we believe that the spending on cloud IT infrastructure will grow at an 11% CAGR and will likely surpass spending in traditional data centers by 2020. There's huge opportunities available because 80% of the enterprise workloads have yet to migrate to cloud, despite a high adoption rate for the multi-cloud strategy. And with higher spending on cloud infrastructure, that will mean that they will require higher cloud-related services, such as data migration and cloud feasibility studies. It is expected that for every $1 spent on public cloud, $2 to $5 is spent on services. The revenue of Amazon is likely to remain vibrant as well, growing at a CAGR of 40% through 2019. As for the global public cloud revenue, it is projected to grow at 40% CAGR, with IaaS, which is infrastructure as a service, growing the fastest. So the top 5 hyperscale cloud service providers, Amazon, Microsoft, Google, IBM, and Alibaba, is expected to grow revenues at a CAGR of about 29%. And that's why with that, we believe that we are still bullish on the cloud computing sector, and we maintain our buy recommendation on the First Trust Cloud Computing ETF, which is SKYY. And some of our preferred companies will be the hyperscale cloud service providers such as Microsoft, Google, and IBM. With that, I'll pass on my time to Jie Yuan, who will talk on the China Weekly.
Thanks, Edmund. I will talk about the China Weekly. That's the week. There's two good news for the China stock market. One is the US and China talks. Both the Chinese and the US side are saying the meetings is productive. The detail of the meetings will be reviewed in next few days. Also, the next round of the meetings will be continues on Washington's. Secondly, the liquidities of the stock market is getting better. Both the money supplies M2s and the new yuan loans are exceed the expectations. Shows the liquidities are getting better. That's the reasons why the stock markets are having a rally today. For the stock recommendations, our Hong Kong research teams recommend HC Group and the CRSC. HC Group is information and the B2B e-commerce companies. There's two main reasons to recommend these stocks. First one is the revenues that exceeded about 200% year-over-year. Secondly, the companies announced there will be corporations with subsidiaries of the Tencent. For the CRSC is infrastructure service providers. There's also two main reasons to recommend these stocks. Firstly, the new orders increased 12.4%, of which the high profit railway orders increased about 44%. Secondly, our Hong Kong research teams seems that the favorable policy environment is a benefit to the companies. For this month, we are waiting for the MSCI index reviews to see whether the MSCI will increase the China Asia's inclusion factors into the 20%. There's a list of the Hong Kong research teams, the stock recommendations. In this week, they add the HC Group, CRSC, and Boston. That's all for this week's presentations. If there are any questions, you can leave on our question board. If there are no questions, we'll end today's presentation. Thank you.